Your credit score, a 3-digit number lenders use to help them decide how likely that it is they'll be repaid on time if they grant you a credit card or loan. It is an important factor in your financial life. The higher your scores, the more likely you are to qualify for loans and credit cards with more favorable terms, which will save you money. If your credit history is not where you want it to be, you're not alone. Improving your credit score takes time, but the sooner you address the issues that might be dragging them down, the faster your credit scores will go up. You can increase your scores by taking several steps like establishing a track record of paying bills on time, paying down debt, and taking advantage of various tools online. You likely have dozens, if not hundreds, of credit scores. That's because a credit score is calculated by applying a mathematical algorithm to information in one of your 3 credit reports. And there is no one uniform algorithm employed by all lenders or other financial companies to compute these scores. Some credit scoring models are very common, however, like the FICO Score, which ranges from 300 to 850. You don't have to get hung up on having multiple scores though, because the factors that make your scores go up or down in different scoring models are usually similar. What makes one score go up versus down is always going to be the same. It just depends on the degree. Most scoring models take into account your payment history on loans and credit cards, how much revolving credit you regularly use, how long you've had your accounts open, and the types of accounts you have and how often you apply for new credit. To improve your scores, start by checking your credit scores online. When you get your scores, you will also get information about which factors are affecting your scores most. These risk factors will help you understand the changes you must make to start improving your score. You will need to allow some time for any changes you make to be reported by your creditors and subsequently reflected in your credit scores. Of course, certain credit score factors are typically more important than others. Payment history and credit utilization ratios are among the most important in many critical credit score models. And together they can represent up to 70% of a credit score, which means they're hugely influential. When lenders review your credit report and request a credit score for you, they're very interested in how reliably you pay your bills. That's because past payment performance is usually considered a good predictor for future performance. You can positively influence the credit scoring factor by paying all your bills on the same time, as agreed every month. Paying late or settling an account for less than what you originally agreed to pay can negatively affect your credit score. You'll want to pay all your bills on time, not just credit card bills or any loans you may have, such as auto loans or student loans, but also your rent, utilities, phone bill, and so on. It is also a good idea to use resources and tools available to you for help, such as automatic payments or calendar reminders, to help ensure you pay on time every month. The credit utilization ratio is another important number in credit score calculations. It is calculated by adding all your credit card balances at any given time and dividing that amount by your total credit limit. For example, if you typically charge around $2,000 each month and your total credit limit across all your cards is $10,000, your utilization ratio is 20%. To figure out your average credit utilization ratio, look at all your credit card statements for the last 12 months, add the statement balances for each month across your card and divide it by 12. That's how much credit you use on average every month. Lenders typically like to see low ratios of 30% or less, and people with best credit scores often have very low credit utilization ratios. A low credit utilization ratio tells lenders you haven't maxed out your credit card and likely know how to manage your credit well. Don't open accounts just to have a better credit mix. It probably won't improve your credit score. Unnecessary credit can harm your credit score in multiple ways, from creating too many hard inquiries on your credit report to tempting you to overspend and accumulate debt. Keeping unused credit cards open, as long as they're not costing you money in annual fees, it is a smart strategy because closing an account may increase your credit utilization ratio, owing the same amount but having few open accounts may lower your credit scores. Opening a new credit card can increase your overall credit limit, but the act of applying for credit cards creates a hard inquiry on your credit report. Too many hard inquiries can negatively impact your credit score, though this effect will fade over time. Hard inquiries remain on your credit report for 2 years. If you have negative information on your credit report, such as late payments or a public item, e.g. bankruptcy, or too many inquiries, you should pay your bills and wait. Time is your ally in improving your credit scores. There's no quick fix for bad credit scores. The length of time it takes to rebuild your credit history after a negative change depends on the reason behind the change. Most negative changes in credit scores are due to an addition in a negative element to your credit report, such as delinquency or collection account. These new elements will continue to affect your credit scores until they reach a certain age. For example, delinquencies remain on your credit report for 7 years. Most public record items remain on your credit report for 7 years, although some bankruptcies may remain for 10 years. Inquiries remain on your report for 2 years. If you simply don't have a credit score, Because you have little experience or history with credit, you likely have a thin credit file. That means you have few, if any, credit accounts listed on your credit reports, typically 1 to 4. Generally, a thin file means a bank or lender is unable to calculate a credit score because there is not enough information in the user's credit history to do so. There are some things you can do to fatten up your thin credit file, such as applying for a secured credit card, becoming an authorized user of someone else's credit card, or taking out a credit builder loan. And that's all for this video. If you enjoyed it, make sure you hit the subscribe button to stay up to date with more videos like this.